For nearly 4 years, millions of Americans experienced a pause in their federal student loan repayments. But in October 2023, that pause ended, unleashing a wave of financial obligations back into the economy. This wasn't a small ripple. According to the Federal Reserve Bank of New York, the total outstanding student loan debt in the U.S. now stands at approximately $1.77 trillion, though some estimates push that figure closer to $2 trillion when private loans are included. This massive sum, accumulated by over 43 million borrowers, represents a significant economic force, and its renewed servicing is already sending shockwaves across various sectors. What does this mean for the everyday American and the broader economy? The COVID-19 pandemic prompted an unprecedented pause on federal student loan payments, interest accrual, and collections, beginning in March 2020. This relief, extended multiple times, provided borrowers with crucial breathing room during economic uncertainty. However, as of October 2023, that era concluded. Estimates from the U.S. Department of Education indicate that roughly 27 million borrowers were set to resume payments. Analysts at the Federal Reserve Bank of New York projected a median monthly payment of around $200 to $299, but for some, the figure is substantially higher. This sudden reinstatement of monthly obligations, for many after years of non-payment, represents a significant and immediate hit to household budgets. The resumption of student loan payments is putting additional strain on an already challenging housing market. Financial advisors, as reported by various news outlets, note that a new monthly loan payment reduces a borrower's discretionary income, directly impacting their ability to save for a down payment. Furthermore, lenders consider debt-to-income ratios when approving mortgages. With student loan payments now back on the books, many potential homebuyers, especially younger generations, may find their debt-to-income ratios too high to qualify for favorable mortgage rates or even a mortgage at all. This phenomenon could exacerbate existing housing affordability crises, particularly in competitive markets. Beyond housing, the ripple effects extend to other significant purchases and everyday consumer spending. Industry reports indicate a potential slowdown in the auto market, as borrowers prioritize student loan payments over new car purchases. For instance, data from Edmunds in late 2023 highlighted concerns among auto lenders regarding increased defaults. On a broader scale, retail analysts are observing a shift in consumer behavior. With less disposable income, households are cutting back on non-essential spending, impacting everything from dining out to entertainment and general retail. This contraction in consumer spending could have wider implications for economic growth, which is heavily reliant on household consumption. While borrowers grapple with renewed payments, the student loan servicing industry stands to benefit significantly. Companies like Nelnet, Advantage, and Mohila, contracted by the Department of Education, earn fees for managing these loans. When payments resume and interest accrues, their revenue streams typically increase. Although the structure aims for efficiency, critics, including consumer protection agencies, have previously raised concerns about transparency and communication issues within these servicers, particularly during periods of high borrower inquiries. The sheer volume of resuming payments, estimated in the tens of millions, represents a massive operational undertaking that, for these entities, translates into substantial operational profits. It's crucial to understand how interest works on these loans, especially after a pause. Unlike simple interest, which is calculated only on the principal amount, most student loans accrue compound interest. This means interest is calculated not just on the original loan amount, but also on the accumulated interest from previous periods. During the repayment pause, interest was temporarily zero. But with its return, and for those on income-driven repayment plans where payments might not cover monthly interest, the principal balance can actually grow over time. This compounding effect means borrowers could end up paying back far more than they initially borrowed, extending their repayment timeline significantly. Many analysts and economists are now referring to student loan borrowers, particularly younger generations, as a lost generation in terms of financial mobility. This debt burden delays major life milestones that were once common for previous generations. Reports from the Federal Reserve indicate that student loan debt is associated with lower rates of homeownership and entrepreneurship among young adults. Borrowers are postponing marriage, having children, and saving for retirement, all due to the overwhelming weight of their educational debt. This isn't just about individual hardship, it represents a societal shift, potentially impacting the future workforce, innovation, and overall economic dynamism for decades. The student loan crisis isn't just a personal struggle, it has broader macroeconomic implications. As millions of individuals reduce their spending and delay investments, the aggregate effect can slow national economic growth. When young, educated workers are burdened with debt instead of contributing to capital formation through savings and investments, the entire economy feels the drag. Economists at the Brookings Institution have highlighted how student debt can suppress GDP growth and lead to a less resilient consumer base. This collective financial constraint acts as a significant headwind, tempering potential expansions in various industries and limiting overall national prosperity. The resumption of student loan payments has undeniably reshaped the American economic landscape. The nearly $2 trillion in debt, once largely ignored during the pause, is now a front-and-center issue impacting housing, auto sales, and consumer spending, while funneling profits to loan servicers. For a generation of borrowers, it means delayed financial independence and limited mobility. As we move forward, the long-term effects of this debt burden will likely continue to unfold, prompting ongoing debates about affordability, access to education, and the sustainability of the current student loan system. The question remains, is this a temporary adjustment or a fundamental shift in the American financial dream?